Hello everyone, welcome to today's US Open live session. It is Thursday, January 18th, 10 minutes before Wall Street opens. As always, volatility around monetary policy expectations is elevated. This given a slew of data and comments from central members that largely push against aggressive market rate cuts pricing, and of course risk aversion due to Middle East hostilities, which support oil prices. In terms of data, we had sticky UK inflation yesterday, and we got a strong employment report earlier with jobless claims falling to the lowest level in months. And now the spotlight turns to Friday's inflation and the central bank's decision early next week. So these are some of the key themes we will be talking about today. But before we begin, as always, please read carefully through the risk warnings and the disclaimers. Once again, please go over the disclaimers and the risk warnings carefully, and then we will begin. Okay, let's get the ball rolling. We're gonna start with Euro USD today, then move to the British pound versus the US dollar, and also talk about the inflation figures from the UK there yesterday. Then we're gonna talk about oil markets, where we have the Middle East hostilities supporting prices, but we also had the latest monthly report from the International Energy Agency, which warned of surplus this year. We're gonna also talk about the SPX 500, and we're gonna round things off with what's ahead, with spotlight mostly on Japan for inflation figures and the central bank's policy decisions. So let's go ahead with Euro USD. Of course, if there are any thoughts, opinions, comments on what we're discussing, please feel free to share those by typing in the chat box. And of course, if there are any questions as well. Now, Euro USD, as you can see on the chart, remains subdued on rate path uncertainty and risk aversion from the Middle East hostilities, but we're going to talk more about that a little bit later once we tackle US oil. On the rates front, markets digest a series of comments from both central banks, which mostly point to lower rates, but push back against aggressive market expectations around rate cuts and call for sustained restrictive stance. Fed Governor Waller, for instance, this week said that he sees no reason to move as quickly or rapidly as in the past. And on the ECB side, we had President Lagarde, who spoke of peak rates and hinted at summer rate cuts. similar to what other officials have done, but that is still much later than what markets price in at this point. We also had a big decline in jobless claims just a little earlier in the US, with the lowest numbers since September, which of course works in favor of hikes. So generally, we've seen fluctuations in pricing around rate cuts from both central banks. Euro USD is in a bit of a tough spot, as it has moved below its 200 period exponential moving average, which makes it vulnerable to 1.722 level. But there's higher degree of difficulty for further losses below that point. And we also have in between the blue line you see on the chart, which is the 200 days EMA, and this can provide support. Despite the poor start to the year and the difficulties that the pair faces, the Fed has been more dovish than its European counterpart, at least in terms of rhetoric, and it's likely to cut rates first. The common currency defend the 38-point Fibonacci, which gives it the opportunity to rebound and reclaim the 1.1 handle, which would bring the December highs back in the spotlight. The December highs, of course, being at 1.1144. In any case, the policy differential is murky at this stage, and that could make firm direction for the pair elusive. Just to sum things up around the policy dynamics, the ECB, the European Central Bank, seems to be in a better position to begin lowering rates, given that it has made substantial progress on inflation lately and its economy is weak, but has not pointed to some such moves anytime soon. It's still more hawkish. The Fed, on the other hand, still has probably more work to do on inflation, and the economy is very strong, and the labor market is very strong. But it has been more dovish and has already pointed to at least 3 rate cuts. And it would probably be hard for the ECB to cut rates before its US counterpart. So you can understand that the policy dynamics right now are in flux. Okay, that's it for Euro USD. Let's move to GBP USD. We can see that there is here on the 4-hour chart a lack of direction as well, again emanating from monetary policy uncertainty. And we had some significant data from the UK this week. Wage growth eased. We already talked about that on Tuesday, which is good news for the central bank. But inflation firmed up according to Wednesday's data, keeping pressure on the central bank for more tightening. CPI ticked up 4% in December, and core CPI stayed at 5.1%. Given weak economy and already massive amount of tightening, policymakers appear that they want to stop tightening, but inflation is still high and wages as well, calling for restrictive stance, and policymakers have not ruled out more tightening. Now, how this translates into the pair? Well, staying above its 200 period, the black line that you see on the chart, and the BOE further from a pivot than the Fed, the pair has the ability to push through 1.28, but the 2023 highs are distant, and those highs are at 1.42. On the other hand, risk aversion is not helpful, and GBP USD remains vulnerable to 1.2499 support level, but strong catalyst would be needed for convincing move below it and towards the 1.23. Now let's switch gears and go to the oil markets. And of course, if you have any thoughts or opinions on what we discussed, we'd be glad to hear them. You can type them in the chat box, or if there are any questions in regards to what we are discussing. Now, US oil stops its 3-month decline, supported by increasing hostilities in the Middle East, which of course is a critical oil and gas hub. The Houthis continue to attack Western vessels in the Red Sea, the entry point for the Suez Canal, and US and allied forces strike against them. And a move that risks further escalation in the area. Iranian missiles targeted Pakistani, Syrian, and Iraqi territories, again threatening further flare-up. Of course, these actions impact of goods and oil, and that is supportive for prices. US oil tries to take out the 200-period EMA and the 23.6 Fibonacci. This is at around 73.5, 74 region. And this could lead to further recovery, 38.2% level, a little above 78. But at this stage, we are cautious around the ascending prospects, despite those, let's say, favorable factors. Today, the International Energy Agency upgraded its demand growth forecast, but still sees a bigger increase in supply of oil, mostly coming from non-OPEC countries, and actually warn of a potential surplus. So that does not bode well. It's actually a headwind for the commodity. And of course, along with China's economic struggles and central banks pushing back against aggressive market expectation for rate cuts, US oil is still in a perilous state and in risk of renewed pressure, although the 2023 lows look distant for now, which are located at 63.63. Now let's to the US index with 4 minutes already into the session. After a poor start to the week, the index regains its full and remains on track for new record highs as investors retain their optimism for multiple rate cuts by the Fed. We said that we have seen some restraint there as markets react to data and to commentary, but they expect 150 basis points of cuts this year. Aggressive, in my opinion, but that's what markets expect. And this process to start in March. As we said, they may be overly optimistic, which leaves room for disappointment. And along with political jitters, this keeps risk of further pressure on the index. And as such, we could see a breach of the 200-period EMA at around 4,695, the black line on the chart, but the downside appears well protected. However, a breach of the 23.6% Fibonacci leg up could open the door to a deeper correction, but strong catalyst would be needed for that. And with that said, let's turn to our attention with what's ahead. It's all about Japan. We expect the inflation figures on Friday. And let's see here how the CPI has progressed over the recent period. That's ex-fresh food, but the central bank targets, which has been slowing, but remains above the 2% targets for 20 straight months, above the 2% targets for 20 straight months. The central bank has hinted towards an eventual exit from negative rates and the ultra loose policy setting. However, it does not appear ready to act because it's traveled by decades of deflation and wants to make sure it has created a virtuous wage price cycle. Policymakers announced their next decision on Tuesday. That's the other major event before our next section. And it looks hard for them to make a change, and they would probably prefer to wait until the spring wage negotiations. And they will also provide updated projections. So definitely